We had to draw down the Strategic Petroleum Reserve. We had to put ourselves into what is kind of a near recession so far, and yet oil's still at the level that it is. So imagine what it is if we were to have another economic cycle without any sort of drawdown in strategic petroleum reserves or things like that. So I think that's probably what's not getting the coverage that it should. And the problem is that if it's not getting the coverage that it should, people aren't really working on fixing it as fast as they probably should be and taking the steps they have to do to give us, 5-year, 10-year, 15-year energy security.
The Federal Reserve has been engaged in quantitative tightening, which translates to the progressive destruction of base money and price inflation, since early 2022. This drains liquidity from the financial system and has a negative impact on the value of financial assets. Lyn Alden, a financial expert, claims that the Federal Reserve encountered a snag in its forward momentum in March 2023, as a result of the banking crisis, which necessitated the Fed making loans to banks. While the Federal Reserve proceeded to destroy base money, it also added liquidity to the financial system while simultaneously draining it. This led to a temporary surplus of cash. However, the Treasury General account has also been depleting since late September 2022. A reduction in the Treasury General account is good for the liquidity of the financial system, in contrast to the balance sheet of the Federal Reserve. When it does a drawdown, it injects the money it took out of circulation. Without a debt limit issue of $500 billion since September 2022, they are moving dangerously close to their intended target. As the Federal Reserve and the Treasury Department have virtually canceled each other out, domestic liquidity has remained relatively stable. In most cases, assets behave similarly. Now, let's watch the video in which Lyn Alden sheds additional light on the current financial scenario, beginning with the currently trending bank issue.
Compared to 2008, so 2008 was a big credit problem, and that was like a gigantic private debt bubble unraveling. This one is obviously more of a duration and liquidity and interest rate type of challenge. And so this one's actually fully within the realm of policymaker control. So it's as bad or as easy as they want it to be relative to the other things they're trying to optimize for, which is primarily inflation, right? So at any time, if they were to cut rates and provide liquidity, the banks are fine. To the extent that they want to, keep optimizing for inflation, then some of the weaker banks are more vulnerable to problems. So that's actually what the key difference is they really have the tools to address this one pretty easily, should they decide to. And so I think it's gonna be. I think the worst is probably behind us. It's kind of famous last words, but to the extent that it does get worse, they have the tools to then shift back and maybe let inflation run her hot while stabilizing the banking system. So they have a bunch of tools on their plate to be able to handle that. I would still be very careful of small banks. I'd be very careful of kind of the lower end of the regional banks, any sort of highly specialized bank. I'd be careful with banks that have a lot of commercial real estate exposure unless you understand that book in very, very high detail. I'm not too worried about kind of the global foreign banks too much, outside of the ones that are always in trouble. And I'm not too worried about the top 10 banks generally in the US. And so I think this is more specific and it's more controllable. And it's really about, basically, if you go back in history, right, how do you come off the zero bound? That's actually a really hard problem for policymakers to do. If you have old interest rates for zero for a long time, how do you eventually get out of that? Because the problem is that when interest rates are zero, you build up so much debt in the system that if you raise rates, it causes a massive problem. And the last time we were in this situation was actually coming out of the 1940s. They after that Great Depression, they eventually had inflation because they did so much fiscal. It was obviously war related, but they did a lot of fiscal. They created a lot of inflation. They inflated a lot of debt away, and they eventually wanted to come off of that zero bound. And back then, their policy was to let inflation run hot and to come off the zero bound gradually. This time, they've taken the opposite approach, where they've they jacked interest rates up from like 0 to 5% in a little over a year. And so that kind of more ham-fisted approach has, led to more bank instability. And they can always walk that back. They can slow it down. They can pause for a period of time, or they can, if they decide to, they can keep jacking that up. And so I think the policymakers going forward are going to balance between that inflation and financial stability kind of set of mandates. And investors obviously have to work around what they think policymakers are going to do there. But I think generally, with so many people talking about it, with so many policymakers looking at the problem, I think it's containable. And I think the thing that people aren't talking about is the thing that they were all talking about last year, which is energy and commodities. I think a lot of people have assumed that that's just fixed now. That we're completely done with any of our energy or commodity problems forever. It's kind of like last year's news. And while I don't really have an opinion on the next 6 months, like I don't, it really depends on again what policymakers do. I mean, if you slow the economy enough, then energy and commodities tend not to be a problem. But I think the issue is the next time they try to have a growth cycle. Let's call it the purchasing managers index. The next time you have a big upswing in the purchasing managers index, or you know economic reacceleration in various forms, however you want to measure it, I think it's likely to come with another wave of inflation, because some of the key drivers of inflation, even though they've been suppressed, have not really been fixed at their root level. And so I think the inflation wave hit harder and faster than they thought. And then it became the number one political issue. If you looked at polls at the time, inflation was the biggest thing. And so the Fed had to basically understand that the models were wrong, and that as much as they would have liked to have let inflation run hot for a period of time, it became so hot so quickly that they had to change into it. And I think the second mistake then was trying to do everything right away. Basically, instead of just accepting there's a mistake now and you can fix it over time, it was like let's turn on a dime and go from 0 to 5% rates. Which, when you have that much debt in the system and you're coming off of that low of a level, you're going to break a lot of things. And instead of letting that policy kind of like take its time to go through the economy, allowing refinancings to happen over time, they kind of just rammed it all through at once. And I think we're probably still going to be dealing with those side effects for quite a while. I don't think we're done dealing with those side effects. And I think the final point I'll make there is that when you hear Jay Powell talk, he's mostly referring to the 1970s. He's referring to Paul Volcker. He's comparing himself to Paul Volcker, essentially. And I think the challenge is that the inflation dynamics we're seeing today and recently are more like the 1940s, which is that, in the 1970s, inflation really had two big components. One was obviously the supply side, like oil limitations, right? So domestic oil production in the United States peaked in 1970, and after like 100 years of going up, it rolled over conventional oil production, and so it became more reliant on imports, and therefore we had all those geopolitical challenges and supply shocks and things like that. But number two, you had a demographic surge. The baby boomers were entering their home buying years. And so you had a lot of lending driven money supply growth. That was basically the peak period of US domestic bank lending. So you did have some money creation from fiscal stimulus, basically the guns and butter policy, but the majority of money creation was coming from banks, and therefore the act of one, fixing the supply side through geopolitical means, and two, trying to tighten monetary policy did do a lot to quell inflation. Whereas 1940s, we had just as high inflation. Actually the year-over-year figure was higher in the 1940s, but the average for the decade was around the same. And the difference was that banks were not lending back then. That was not from excessive bank lending. Money creation was not coming from banks. It was coming from very large monetized fiscal stimulus, which was obviously war related, but a lot of that war related spending was domestic. You were building manufacturing facilities. You were getting commodities. When the GIs came home, there was the GI Bill that sent 8 million of them to college and technical school, and then subsidized their mortgages. Basically, that's a domestic stimulus, a fiscal stimulus. And so you had this huge money supply growth, monetized by the central bank and the broader banking system. And so, very big surge in broad money, quite inflationary. Um, and rates don't really affect that. Like rising rates doesn't really affect how much the government's going to spend. And if anything, it actually makes them have larger deficits because they're paying higher interest on their debts, and that's adding to the deficit and actually contributing to money supply growth as you take money supply growth out from elsewhere. And so I think basically the dynamic we're facing now is that inflation is going to be a rolling concern as long as fiscal deficits are very, very large, and as long as we have supply constraints on the commodity side.
Over the last 6 months, the U.S. federal government ran a deficit of $1.1 trillion, and large deficits are expected to persist in the future. The Federal Reserve is a net seller of the most commercially relevant U.S. Not only are banks not purchasing treasuries, but neither is the foreign sector as a whole. Ultimately, policy shifts are expected to overcome the post-debt ceiling liquidity cliff. Not one of them is simple, though. The question is who will fill this large demand for treasury purchases. Thank you for watching Market Empire, and we hope you found this video on the unbelievable update on the financial crisis insightful. If you enjoyed this content, please give us a thumbs up and subscribe to our channel for more informative videos. Stay tuned for more updates on the world of finance, investing, and economics.